Is a larger half-point interest rate cut by the Fed back in play? Let's ask Eric Lynch of Scharf Investments, and I'm Lisa Bernhard with Reuters. Eric, today, Friday, it looks like now a nearly 50% chance, that's come up a lot, that the Federal Reserve might cut interest rates by as much as a half a point next week. What do you make of that sudden rise in that probability by investors?
Yeah, Lisa, it's reflective of what we've seen since the third quarter started, which is a lot of consternation from investors about where the economy is going, where inflation is going to land, and what the Fed can do in terms of rate cutting. And so stocks, the VIX, and now the CME Fed Watch tool is jumping all over the place. In the wake of the CPI report on Wednesday, because core inflation was accelerating month over month and still relatively high year over year, very sticky. That probability of a 50 points cut was 15%. Now it's above 50. So I think it's just really indicating that investors really don't know which way the Fed's going to go and which way the economy is going to go.
Well, how much of a difference do you think it will make, whether it's 25 or 50 basis points? And when would consumers and businesses start to feel either one?
That's a good question. A great debate. In terms of whether it's 25 or 50, don't think it matters too awfully much in the short term. What's more important, Lisa, is what's the general trend the next three kind of FOMC meetings this year? The forecast is we're going to have 100 bips of cut. You can't always believe forecasts because we started the year and there was going to be 7 cuts of 25 basis points this year. So it's hard to see. But the important thing is what's the trend in terms of what the impact could be. You could break it down between short and long term. Short term, certainly it could give some relief to Main Street. A lot of consumers, unfortunately, are faced with using their credit cards to finance their household spend with this increased inflation. And so you've got this really high acceleration of credit card balances. Delinquencies are up. Interest rates for credit card balances have kind of gone from 16 to 20% in the last few years. And so that would give immediate relief because that's variable kind of credit card rates. It doesn't have a huge impact on things like mortgages, where most of those are long-term for most people with mortgages already. For younger folks, for people looking for their new home, their first homes, mortgages are already kind of baking in some cuts. In the last 30 days, the 30-year fixed mortgage rate average has decreased from roughly 7.3 to 6.3. So that's some of the things that we could see going forward. But in terms of equities, 50 basis points would certainly probably give a renewed vigor to the equity markets.
In addition to the latest inflation data this week, we saw the first presidential debate between Kamala Harris and Donald Trump. And solar stocks popped the next day, which indicates the potential, perhaps, of a Harris victory. And that's the opposite of what we saw after the assassination attempt on President Trump, when the full Trump trade was in full swing, right? And that's like Bitcoin-related stocks or prison-related stocks or gun-related stocks, or his own Trump media, in fact. How much of those candidate-related stocks actually hold and do well once a candidate is elected to office, like through their presidential term?
It's a great question, and obviously these types of questions peak associated with every presidential election cycle. And one would think that there would be a strong correlation between policy positions and ultimate kind of stock returns. What we've seen historically is there's not. When you look at Lisa, one of the kind of interesting facts about the energy sector is drill baby drill Trump. Right, the energy sector was the single worst sector during his presidential term. There will be no fracking on federal lands going forward in the 2020 presidential election cycle. Biden, energy was, has been his best returning sector for his term. So it's really hard. There's a lot of conditions where we are in the economic cycle, whether or not we have split party kind of congressional power. There's a lot of things that kind of are more important that kind of drive stock returns.
What else might people be surprised to know about stock performance over the most recent presidential terms?
Yeah, one would intuitively think that Republican administrations, oftentimes associated with lighter regulatory touch, more supportive tax policy for publicly traded corporations, that would translate to better equity returns than Democrats. That's not been the case at all, Lisa. What's very interesting is that in the last 30 years, the Clinton administration, his two terms, were basically annualized return average of 17.5%. That's the best of any president in that period. The single worst was George Bush's annualized negative 4.5. Interestingly, between Obama and Trump, Obama being, obviously the kind of leadership behind the Affordable Care Act, kind of a heavy medical kind of industry support and intervention from the government, he averaged 16.3% return, same as Trump, 16.3. So it's really, I like to tell investors that, building your investment house on political policy kind of projections is like building your foundation on quicksand. It's just not a good foundation.